Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Trent DeBruin, and I'm joined, as always, by my co-host, Andrew Mushbaugh. And today we're going to talk about saving for college. And don't worry, when it comes to this topic, we can definitely empathize with all of you who are saving for college. I have 3 kids, 6 and under, and Andrew and his wife just had their first baby, and we're just as depressed looking at the projections for the future cost of college.
Yeah, I couldn't help myself, and I definitely already ran the college projections, and luckily it looks a little better paying for Miami of Ohio or Michigan than Notre Dame.
Yeah, it's all relative, right? But to start out, one thing we want to mention is that there's no right or wrong answer when it comes to saving for college.
Other than assuming your kids are going to get an athletic scholarship as your college savings plan, of course.
Yeah, make sure that's plan B or C, but not plan A. But in working with clients, we found that people's views about saving for college are often impacted by their own experience. And because of that, there can be different perspectives even among spouses. Some people want to pay for everything, while others want their kids to have some so-called skin in the game and pay for either some or all of it. But understand there's no right way, and we don't want people feeling any guilt or pressure about how much they should pay for. That being said, regardless of how much you're paying for, if you're saving any money at all for college, it makes sense to do so in a way that's going to maximize the impact those dollars are going to have, so you get the most bang for your buck with your savings. And this is especially important as a physician because you most likely won't qualify for any financial aid due to your income. And in the discussion today, we're going to focus on how to optimize the way you're saving for college as opposed to figuring out how much you should save, because that answer is going to vary dramatically depending on a number of different assumptions. Things like how much you plan to pay for, what school the child attends, how many years until the child is college age, and other assumptions like investment returns and tuition inflation. But on that note, we do want to provide some quick perspective on the cost of college. And the last time we checked, the average Michigan public university costs about $26,000 a year for both tuition and room and board. So about $104,000 for a 4-year program. And the average private university, on the other hand, costs about twice as much. So around $54,000 a year, or $216,000 for a 4-year degree. And those are today's prices, so keep in mind that the price of college continues to rise, and over the past 10 years, it's risen much faster than general inflation.
Yeah, and people have been saying for a long time that inflation can't keep going up as much as it has, yet the trend has continued, and it's a steady increase each year.
So it's safe to say that a college degree today has a big price tag, regardless of which school you go to, although obviously school choice can have a big effect as well. And when thinking about saving for college, there are many different options. So on one extreme, you could save to a bank account that doesn't pay any interest and doesn't give any tax advantages. That'd be the suboptimal option. Then on the other extreme, you could save to an account that allows you to invest the money and also provides multiple tax advantages at the same time. And this second approach describes a 529 plan, which tends to be the best option for saving for college and is what we're going to focus on today.
Yeah, a 529 plan is the best way to save for college, and we describe it essentially as a 401k for college savings. So in the simplest terms, it's a tax-advantaged account to use for saving for college. And there are 2 different types of 529 plans in Michigan, which we'll talk about in a bit, but one is an actual saving and investing account, while the other is a prepaid tuition program. And the most common type of 529 plan allows you to make contributions to the account to be invested. Your investments grow tax-deferred. And then in the future, if you used it for qualified education expenses, you're also able to withdraw from the account tax-free. So essentially, you get a triple tax benefit. And each state typically has their own 529 plan with varying investment options. And each state also has different tax incentives they offer their residents. So for instance, in Michigan, the tax deduction you get depends on your tax filing status. If you're single, you're able to deduct up to $5,000 of contributions, versus if you're married and you file taxes married filing jointly, then you're able to deduct up to $10,000 of contributions. And it's important to note that to get that Michigan state tax deduction, you have to actually contribute to Michigan's 529 plan. And it's rare to find any accounts in the financial world that have a triple tax benefit. And that's why this is the best account to use when you're saving for college.
And to illustrate this, it's probably helpful to look at an example. So let's say Andrew and I are both at a racetrack driving laps, where the number of laps we each drive represents the total value of our college savings accounts. But the key difference is Andrew's driving a minivan, which is like saving for college using a regular account with no tax benefits. and I'm driving a Ferrari or using a 529 plan. And that's not to knock minivans. My wife drives one and she loves it.
Trent, it's okay to admit you like driving the minivan too.
I will never admit that. So Andrew and I start in the exact same spot on the racetrack. Then we drive for the same number of hours per day for the same number of days, which would be similar to saving the same dollar amount to our college savings accounts for the same number of years. Well, at the end of it, I'll have driven a lot more laps than Andrew. In other words, my college savings account will be worth more. We drove for the same amount of time, but I just had the better vehicle. And it's the exact same way when it comes to saving for college, where you want to use the most efficient vehicle possible to maximize the impact of your savings. And this is really the essence of financial planning. It's about optimizing the way you use your resources. And as Andrew mentioned, one of the best aspects of the 529 plan is that triple tax benefit. So we want to explain this in a little more detail. And the first tax benefit is the income tax benefits. So there's no federal tax deductions for 529 contributions, but there are state ones. And not all states offer them, but Michigan fortunately does. And as Andrew mentioned, in Michigan, you're able to deduct up to $10,000 if filing taxes married filing jointly and $5,000 if filing taxes single when contributing to that traditional Michigan 529 plan. And we'll talk more about the two types in a little bit. But knowing that the Michigan state income tax rate is 4.25%, if you contribute $10,000, that's $425 in tax savings each year if you file taxes married filing jointly. It's important to note that in Michigan, the amount you can deduct is based on your net contributions. So if you put in $10,000 and took out $10,000 in the same year, you wouldn't receive a deduction. So you want to be aware of that and be strategic with your contributions and your deductions. And you also have to be a Michigan taxpayer, and you only receive the deduction if you contribute to Michigan's 529 plan. And you're still allowed to contribute to other states, but you just don't receive the same tax benefit. For example, I still have an Illinois 529 plan for my oldest son from when we lived in Chicago, but I no longer contribute to it because there's no tax benefit. I just contribute to his Michigan 529 instead.
And you didn't add any stipulations about Bennett having to go to Notre Dame, did you?
Yeah, that's part of the deal. He just doesn't know it yet. He'll find out eventually. And the nice thing is with these income tax benefits is there's no income limits on the deduction. And that's especially relevant for physicians since a lot of the other tax breaks out there fade out after a certain income level. But with the 529, you receive those tax breaks whether you make $150,000 or $1 million. Also, know that the tax deduction goes to whoever owns the account. So grandparents in Michigan who set up a 529 for a grandchild and contribute to it will receive that tax benefit. And the second part of the triple tax benefit for 529s is tax-free growth of the account. Once you make contributions, you're able to invest the money by choosing among a number of different investment options, similar to your 403b or your 401k. And investments, stocks and bonds, often pay income and capital gains each year. So you get to avoid paying taxes on these in a 529 count, which helps your money grow faster because it removes some of that tax drag from the account growth. And lastly, the third tax benefit is those tax-free withdrawals. With other investment accounts, like that traditional 403b or 401k for retirement, you receive a tax deduction when you contribute, and the money grows tax-free, but then you need to eventually pay taxes on it when you withdraw it. However, that's not the case for 529s. There's no tax you have to pay when you withdraw the money and use it for qualified education expenses.
Yeah, so hopefully by now you can see why we like 529 plans so much. And I'm still working on Jenny's appreciation of the 529 plan. We just touched on some of the benefits of saving to the account. And the key point to remember when you're distributing from the 529 plan is an understanding of what those qualified education expenses are, because that determines if your distributions are tax-free. And so the most common ones are tuition and room and board, but many people don't realize it also includes things like computers, books, technology expenses, fees and supplies, and other equipment. So basically anything directly related to education. And this has actually changed a little bit over time too. In the past, 529 plans were just meant for college savings, but in recent years, following the Secure Act and the CARES Act, they've expanded the definition to include K-12 private school costs in some states, and even up to $10,000 to repay student loans. And so for the K-12 private school costs, although it was passed federally, each state follows their own guidelines, and Michigan currently does not explicitly count K-12 private school costs as a qualifying expense. And in addition to some of those tax benefits, another great aspect of the 529s is the flexibility. So as Trent talked about, anyone can open one, not just parents, grandparents, aunts and uncles, but even friends can open it. And anyone who has an interest in helping out with the child's education, you can open a 529 plan.
So I always like to remind Andrew that he's more than welcome to contribute to my kids' 529 plans if he wants to.
Yeah, I think I'm going to stick to Paw Patrol toys for the boys as gifts. And like Trent mentioned, he still has an Illinois 529 plan, and you're not limited to using your own state's 529 plan. You can use any state's, but each state has different investment options. So some prefer to look at other states' 529 plans to get those better investment options. However, it is important to keep in mind that you don't receive your state's income tax deductions unless you contribute to your state's 529 plan, which is why we recommend our clients in Michigan contribute to the Michigan 529 plan. And just as you can open a 529 plan in various states, each child can have multiple 529 accounts. For instance, one owned by parents, one owned by grandparents, or one owned by Uncle Fun for Trent's kids.
For example, and this is kind of overkill, but my oldest son has 3 different 529 accounts. So he has one in Illinois from when we lived in Chicago. He has his current one in Michigan, and then he also has one in Wisconsin. My parents who live there opened one up for him.
You're definitely probably going to have to use all 3 of those accounts to pay for Notre Dame school.
Yeah, probably true.
There are also no limits on annual contributions. So unlike most retirement accounts, your 403B, a 401k, or an IRA, where you can only put in $19,500 or $6,000 to an IRA, there's not a cap on 529 plan contributions. So the only limit is on the tax deductions that you get. So that's $10,000 in Michigan for married filing jointly. And then if you're making a large lump sum contributions, we won't go into the details right now, but you want to be aware of some of the rules to avoid having the contribution go against your lifetime estate tax exemption. Again, not an issue now, but we want you to at least be aware of some of the more unique situations that could come up. And the only limit for 529 plans in Michigan is a $500,000 balance per account.
And we've yet to have a client run into that issue, and I don't know that we will, but worth at least mentioning.
Yeah, the last benefit's really easy to set up and contribute to a 529 plan. You can set up automatic monthly contributions, paying an annual lump sum, or whatever combination works best for you. And with any of the items in financial planning, we always like the idea of paying yourself first for any of the goals that you're saving for and have some type of automatic contribution, whether that's monthly or annual, because that's going to help you make sure that you're saving enough for those goals.
As we've alluded to, there are 2 different 529 plan options in Michigan. One is the Michigan Education Savings Program, which we'll refer to as the MESP, and the other one is the Michigan Education Trust, which we'll call the MET. And not all states offer multiple options when it comes to 529 plans, so we thought it'd be helpful to explain the 2 and share some of the pros and cons of both of them.
Yeah, the first and most common one is the MESP, and this is a traditional 529 plan, and this is the type of 529 plan we focused most on our discussion so far. We've already touched on several of the benefits, but essentially it's a saving and investment account that you can manage yourself, pick the investments, and also have the flexibility of how you spend that money in the future. And in terms of logistics of opening the account, we know not everyone is comfortable picking out an investment allocation, which is why the nice thing with the MESP 529 plan is that they offer what's called age-based investment models, where it gradually gets more conservative as your kid gets closer to college at age 18. And this is essentially like a target date retirement fund in your 401ks or 403b. And it's just great for those that don't want to create their own investment allocation. So you have the option for them to choose it on your behalf based on the age of your child. But you also typically have the ability to pick your own investment choices if you are comfortable doing that. And lastly, it's really easy to withdraw the money from an MESP plan when you need it. You can send the money directly to the institution, directly to the beneficiary, or just to yourself to reimburse yourself. But you do want to make sure that you're keeping receipts for verification of those costs and expenses you have. And in terms of a potential drawback, the main one is that if you don't use the funds for qualified education expenses, then you have to pay taxes on the earnings and also a 10% penalty. And this is why we typically don't recommend our clients have 100% of college costs fully paid for by the 529 plan, where you end up having more money than you need in your 529 plan. But having said that, there are options where you can change the beneficiary to a younger child, or even looking far into the future, you could even switch the beneficiary to any of your grandchildren.
So that's on the MESP, but then the other type of 529 plan in Michigan is the MET. And this one is a much different type of plan. It's essentially a prepaid tuition plan. And this type is much less common. I think there are only about 12 states that have it compared to all 50 states that have a traditional 529 plan. But instead of saving and investing account, you're able to buy future college credits at today's prices. And pricing is based on the average tuition for Michigan public schools. And if you buy credits in a lump sum rather than using the payment plan, your rate of return ends up being the rate of college tuition inflation. And over the past decade, that's been around 5% a year, so much higher than general inflation, but also lower than the stock market, which has averaged about 10% returns over the past decade, which is similar to its historical average. Although it's worth noting that there's no guarantee that'll continue in the future with the stock market, and you may or may not have realized that in a traditional 529 plan over the past 10 years, since you may or may not have been invested 100% in stocks. But with a MET, you buy credits, which is called buying a contract, and there are different types, so it can get a little bit confusing, but you can basically buy either a full benefits contract, which pays for tuition at any Michigan public school, or a limited benefits contract, which pays tuition up to 105% of the Michigan public school average. So because of that setup, you'd maximize the benefit if you bought a full benefits contract and went to one of the most expensive colleges in Michigan. So Michigan Tech, U of M, or Michigan State. But if you ended up going to a different school, that limited contract would make more sense since the cost of tuition would be cheaper. And one of the biggest benefits of the MET is just its simplicity. So you choose the contract and you either have a lump sum payment or a set monthly payment. So you don't have to make decisions about how to invest the money, so there's no investment strategy involved. Another benefit is the potentially larger tax deduction. So with a traditional 529 plan in Michigan, the MESP, you're limited to up to $10,000 annual deduction. However, for the MET, there's no limit. The only limit is that $500,000 account value, so you could theoretically contribute up to $500,000 in a lump sum and get a tax deduction if you had the income to offset that. But when thinking about the drawbacks for the MET, one of the main ones is that your return is limited to the rate of tuition inflation. There's no potential to do any better. Also, you have to know that there's a rate of return baked into these contracts, and it's about 5%. So if you're doing the payment plan for the MET rather than the lump sum payment, you're going to end up paying more for those credits. For example, if you're on the monthly payment plan, each year you'll end up paying around 5% more for the same college credits. And that can really add up over the lifetime. So if you end up doing the payment plan for the entire 15-year period, you're going to pay 50% more for those credits compared to if you just did a lump sum payment at the beginning of the period. So really, the scenario where the MET prepaid tuition option makes the most sense is if you're paying in a lump sum, but that's also much more difficult because not everyone has the cash on hand to make those big lump sum payments. Another drawback of the MET is that it's not as flexible as the MESP. It only covers tuition and fees, so you can't use it for room and board and some of those other qualified education expenses. And for those, you can use the traditional MESP plan instead. Also, the MET is meant for undergraduate education, so you can use any leftover credits for grad school, but you receive undergrad tuition value for them. And while there are a few different payment options, payments are often set contractually, so there's less ability to adjust them, which is much different than the MESP plan, where you can adjust that payment at any time. And lastly, if you do end up going to a Michigan private school or any out-of-state school, you'll receive a refund for your MET plan, but the value is going to be less than if you used it in-state at a Michigan public school.
Yeah, so knowing all of those differences, the logical next question is, what's the best option for you? And the MESP is a better option and what we typically recommend for someone who desires more flexibility of how the funds can be used, or if you're unsure where your kid will go to school between in-state versus out-of-state, or if you want the potential to achieve a higher return by investing some of those contributions. Whereas the MET may be a better option for someone who is certain about state school, particularly one of the most expensive ones, and you don't want to worry about investing or managing the account, and you can ideally make those contributions as a lump sum rather than as monthly or annual payments. And obviously there are fewer people who fit that last description for the MET, which is why we generally prefer the MESP for the flexibility and option to invest your contributions.
So as we get ready to wrap things up here, the last thing we want to cover is some of the common questions we hear about 529 plans. And one of the biggest ones is, what happens if my child doesn't end up needing the money? Maybe because they received a scholarship, had a change of plans, or something else.
Yeah, and I touched on this briefly, but there are a couple different options. You can change the beneficiary or withdraw the money. And changing the beneficiary is generally preferred because there's no penalty and it's usually pretty flexible in terms of the definition of who you need to change the beneficiary to. It can be immediately family, in-laws, first cousins, and since it will still be used for education, just for another beneficiary, it's not penalized by the government. Now, the second option is to just withdraw the money. And there are two types of withdrawals. The first one is a qualified withdrawal, which means your child receives a scholarship or enlists in the military. And this is considered a good reason, so it's more favorable tax treatment. And generally, you'll just pay state and federal taxes on the earnings, which is the difference between what was paid in or contributed versus what it's now worth. And then the other type is a non-qualified withdrawal. And this is where the child decides not to go to school or you just want the money. And so this one's less favorable in terms of the treatment because the goal of a 529 plan is aimed for education. And so generally with these non-qualified distributions, you pay state and federal tax on the earnings plus a 10% penalty. And you may also have to go back and pay back state tax deductions claimed in the past. So you definitely want to avoid non-qualified withdrawals if at all possible. And there are more restrictions for MET in this area of non-qualified withdrawals. The value for the MESP refund is what it is, but a MET withdrawal depends on the contract. So the MESP refund can be all at once, but the MET withdrawal is over a 4-year installment. And there's also a difference in time limit of the withdrawals. There's no time limit for MESP, can keep it for the next generation, but with MET withdrawals, they must be used within 15 years of the beneficiary turning 18.
So that covers everything we wanted to discuss about college planning in Michigan, and hopefully you found the discussion helpful and informative. As we mentioned at the beginning, there's no right or wrong answer in terms of how much to save or pay for when it comes to college, but if you're going to save any money for kids, grandkids, nieces, nephews, or other, it makes sense to do it in a way that maximizes the benefit and stretches those dollars as far as possible. And we found that a 529 plan is the best way to do this. As a physician in Michigan, you have those two options when it comes to Michigan 529 plan, so you'll want to decide which one is right for you. Although, as we mentioned, we generally prefer the flexibility of the MESP, which is that traditional 529 plan. And for those super savers out there, one thing to note is that we don't recommend that you have 100% of the expected college costs covered by a 529 plan, because you want to avoid worrying about having to pay that penalty if you have money left over and have to take it out for something other than college. So we typically recommend people only fund up to 80% of the expected total college cost to a 529 plan, and then supplement the remaining amount through cash flow or saving to a taxable investment account. And the key message we want to leave you with is that when you're thinking about saving for college, remember the goal is to be in the Ferrari and not in the minivan. We appreciate you joining us for another episode of the show, and we thank you for the time you spend with us. If you have thoughts to share or questions you'd like to have answered, please feel free to email us at info@mdwmllc.com. You can also visit the podcast page of our website, mdwmllc.com, to access the show notes and everything that we covered today. We'll also include in there a resource we put together on some of the frequently asked questions for Michigan 529 plans. Take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.